For decades, the American housing market was built on a simple promise: work hard, save steadily, and eventually you could buy a home. That idea shaped the middle class. It shaped suburbs, cities, and the dreams of millions of families who believed a small house with a yard meant stability. But sometime in the past 15 years, something quietly shifted. It did not happen overnight, and it did not arrive with dramatic headlines. Instead, it crept in slowly, hidden beneath statistics that seemed normal on the surface. At first, the warning signs looked like temporary problems. After the financial crash of 2008, housing construction slowed dramatically. Builders became cautious. Banks tightened lending standards. Entire construction companies disappeared during the recession, and many never returned. In the years that followed, the United States began producing far fewer homes than its growing population required. At the time, few people noticed the long-term consequences. The market appeared to recover. Prices stabilized, mortgage rates remained low, the crisis seemed to be over. But beneath that calm surface, the supply of homes was quietly shrinking compared to demand. By the mid-2010s, the effects began to appear in certain cities. Prices started climbing faster than incomes. In places like Seattle, Austin, and Denver, bidding wars became common. Buyers would visit a home listing in the morning and find it sold by the evening. Sellers realized they could ask for more money than ever before. Investors noticed the trend and began entering the market aggressively. This was the beginning of a new phase of the housing market. Large institutional investors, companies managing billions of dollars, started purchasing single-family homes in growing metropolitan areas. At first, their presence seemed small, but their strategy was clear. Instead of flipping homes quickly, they held onto them as long-term rental assets. Entire neighborhoods gradually shifted from owner-occupied houses to corporate rental portfolios. For families trying to buy their first home, the competition changed overnight. A young couple might spend months saving for a down payment, only to lose a bidding war against a company offering cash. These companies could close quickly, waive inspections, and outbid traditional buyers by thousands of dollars without hesitation. What looked like ordinary competition in the market was actually something new: housing transforming into a large-scale financial asset. At the same time, another trend quietly intensified the pressure. Millions of Americans who bought homes years earlier locked in extremely low mortgage rates, often below 3%. When interest rates later began rising, these homeowners had little reason to sell. Moving would mean replacing a very cheap mortgage with a much more expensive one, so they stayed where they were. The result was fewer homes entering the market. Economists call this phenomenon the lock-in effect, and its consequences spread quickly across the country. Inventory shrank, listings dropped. In many cities, the number of available homes fell to historic lows. Buyers were left competing over a limited pool of properties, which pushed prices even higher. Then the pandemic arrived, accelerating everything. During 2020 and 2021, mortgage rates reached historic lows, and remote work changed where people wanted to live. Families who once needed to stay near city offices suddenly discovered they could move almost anywhere. Suburban towns, smaller cities, and previously quiet regions experienced a sudden surge of demand. People fled expensive coastal areas and flooded into places like Texas, Florida, Tennessee, and the Carolinas. Home prices exploded. In some regions, prices rose more than 30% in only 2 years. To many homeowners, it looked like prosperity. Their houses were suddenly worth far more than before, but for renters and first-time buyers, the same surge meant something entirely different. The price of entry into the housing market had jumped dramatically. And then interest rates began rising. Mortgage rates doubled in a short period, dramatically increasing monthly payments for new buyers. A house that once required a manageable mortgage suddenly demanded hundreds or even thousands of dollars more per month. Affordability collapsed faster than at any time in recent decades. Yet even as affordability fell, prices did not drop enough to restore balance. This is where the hidden crisis begins to appear. The American housing market is no longer simply about supply and demand in the traditional sense. It has become a complex system shaped by investor ownership, limited construction, locked-in homeowners, migration shifts, and interest rates moving at historic speeds. Each force interacts with the others, creating a market that behaves differently from the past. To many people watching the headlines, everything still appears normal. Home prices fluctuate, mortgage rates rise and fall. Real estate agents continue listing properties every day, but beneath those familiar patterns, the foundation of the housing system is changing. And the consequences are only beginning to unfold. The deeper the housing market changed, the less it resembled the market most Americans thought they understood. On the surface, it still looked familiar. Houses were being bought and sold. Mortgage applications were still being filed. New neighborhoods were still being built in the outer suburbs. But underneath that ordinary movement, ownership itself was beginning to shift in a way that few buyers fully understood. For most of modern American history, housing was mainly a local business. Families bought homes from other families. Small investors owned a few properties at most. Builders constructed neighborhoods for individual buyers. Even when speculation entered the market, it usually moved through recognizable channels. But after the financial crisis and into the next decade, a different kind of buyer entered the scene. These buyers were not moving in to live. They were moving in to hold, package, and extract value. At first, the scale was not obvious. A handful of homes here, a few dozen there, in fast-growing metro areas that seemed normal. Investors had always been part of housing, but then the numbers began to change. Some firms were no longer buying just one or two houses in a neighborhood. They were buying dozens, then hundreds, then thousands. They targeted markets where demand was strong, where population was rising, and where homes could easily be turned into rentals. The goal was not ownership in the old emotional sense. The goal was yield. That shift mattered because it changed the logic of competition. A family buying a home wants to live in it, maintain it, and eventually build equity. A corporate buyer thinks in terms of return, occupancy rates, asset appreciation, and long-term financial efficiency. When those two buyers compete for the same property, they are not playing the same game. One is trying to create a life. The other is trying to optimize a balance sheet. In cities that were already under pressure, this distinction became painfully clear. A young family could lose a home because an investor could close quickly. A retired couple could watch a neighborhood rise in price not because of a sudden wave of local prosperity, but because outside capital had discovered the area. People who had lived in those communities for years began to feel as if the market was no longer designed for them. It was being priced around them. The rental market became part of the same system. As more homes were purchased by investors, more former buyers became renters. That put upward pressure on rents. As rents rose, investors gained more revenue. As revenue improved, more investors entered the market. It became a cycle that reinforced itself. The higher the housing costs climbed, the more profitable single-family rentals appeared on paper. The more profitable they appeared, the more homes were removed from the pool available to owner-occupants. Meanwhile, local governments were slow to respond. Zoning laws in many places restricted new construction. Neighborhood opposition to density remained strong. Even where demand exploded, building new homes often took years. Communities wanted more affordable housing in theory, but not necessarily apartment buildings, townhomes, or denser developments nearby. The result was a structural contradiction. The country needed more homes, but the system to produce them remained too slow, too expensive, and too politically fragmented. That is one reason the shortage never truly corrected itself. Then came the mortgage rate shock. For years, low borrowing costs had acted like a hidden support beam under the housing market. People could stretch a little farther. Monthly payments stayed manageable. Prices could climb because money was cheap. But once rates rose sharply, the market revealed how fragile that balance had been. Buyers who could once afford a home suddenly could not. The same house now carried a much larger monthly cost. In practical terms, this shut millions of people out. Yet the expected correction did not fully arrive. Prices did not collapse in most places. Instead, they stayed stubbornly high. That created a strange and painful market. Sellers wanted peak-era prices. Buyers could no longer afford them. Inventory remained tight because homeowners with low mortgages did not want to move. Builders were still struggling with costs. Investors were still present in many markets. Everyone was waiting for relief, but the relief did not come. This is why the crisis stayed hidden. There was no single dramatic moment where the entire system broke. Instead, the system became harder and harder to navigate, especially for ordinary families. A house was no longer just a place to live. It was a scarce asset, a financial instrument, a monthly burden, and in some places, a battleground. The result was psychological as much as economic. People began to lose faith that buying a home was even possible. Younger Americans started to assume that ownership belonged to a previous generation. Renters extended their timelines. Parents worried that their children would never be able to afford the same kind of stability they once took for granted. Real estate, which had long been sold as the safest path to security, began to look like an obstacle course. And still, the market kept moving. That was the most unsettling part. There was no collapse to point to, no clean ending, no headline that could fully explain what was happening. Instead, the housing system slowly became less accessible, less fluid, and less fair for the average buyer. By the early 2020s, the pressure inside the American housing system began to appear in ways ordinary families could feel. Rent increased faster than paychecks. Homebuyers struggled to compete in bidding wars. Real estate agents quietly admitted that even well-qualified buyers were being shut out. None of these moments looked dramatic on their own, but together they formed a pattern impossible to ignore. At the heart of the problem was affordability. For decades, housing costs had risen roughly in line with wages. Families could plan. A starter home might be modest, but it was a foothold in the market. That balance broke down dramatically after the pandemic. Home prices surged faster than household income, especially in fast-growing metro areas and states attracting new residents from coastal cities. Cities once considered affordable, Austin, Raleigh, Phoenix, Nashville, began to feel just as unattainable as San Francisco or New York. The pandemic accelerated trends already in motion. Remote work allowed families to leave expensive urban centers and move to previously overlooked regions. Suddenly, a small town in Texas or Florida became a hot housing market. Demand outpaced supply almost instantly. Builders struggled to catch up. Labor shortages and rising material costs slowed construction. Zoning laws limited new developments. Even when homes were built, they were often priced beyond what middle-class families could afford. Then interest rates rose sharply. Mortgage rates doubled in a short period, dramatically increasing monthly payments for new buyers. A house that might have been affordable in 2021 suddenly required hundreds of extra dollars per month. Buyers who had been pre-approved months before suddenly found themselves unable to qualify. Sellers, who purchased their homes years ago at low rates, were unwilling to lower their prices. Low mortgage rates had locked many homeowners in place, reducing available inventory even further. Renters bore the brunt of the collapse. As buying a home became less achievable, demand for rentals surged. Landlords raised rents, and some entire neighborhoods became unaffordable to long-time residents. Migration patterns shifted. People who could no longer afford housing in one area moved to another, driving up prices there, creating a chain reaction that affected the entire country. The crisis was no longer localized. It was national, subtle, and relentless. What made this collapse hidden was that there was no dramatic crash. There were no empty subdivisions or foreclosures on the scale of 2008. Prices remained high. The market did not fail. It became inaccessible. Millions of Americans could see the cost of owning a home, but the path to get there had disappeared. Starter homes vanished, replaced by rentals or large, investor-targeted properties. The ladder that once allowed young families to climb toward financial stability was gone. The combination of investor activity, rising mortgage rates, underbuilding, and migration shifts created a perfect storm. Families delayed buying, neighborhoods shifted demographics, and regional markets responded in uneven ways. The system no longer worked the way it had for previous generations. Housing, once a promise of security, became a source of uncertainty, stress, and inequality. By 2026, the pattern was clear. Affordability had collapsed across wide swathes of the country. The market moved, but the people who needed it most, the first-time buyers, the working-class families, the middle-class dreamers, found themselves increasingly shut out. What appeared as normal market behavior was, in reality, a hidden crisis quietly reshaping American life. As the United States moves further into the 2020s, the future of its housing market feels both familiar and unpredictable. The forces that shaped the last decade, limited supply, high demand, rising interest rates, and investor dominance, remain, but new trends could redefine the system entirely. What happens next depends not just on prices, but on policy decisions, demographic shifts, and the choices of investors and ordinary Americans. One possibility is gradual stabilization. Mortgage rates may level off, builders could finally respond to decades of underbuilding, and migration patterns might normalize. If local governments revise zoning to allow higher density housing, and if incentives are offered for affordable construction, the market could ease for first-time buyers. Prices might continue rising, but at a slower, manageable pace. The housing ladder, while still steep, might once again become navigable. Yet alternative scenarios carry greater uncertainty. Investors who now own thousands of single-family homes could decide to sell if profitability decreases or interest rates rise further. A sudden wave of investor sell-offs could flood certain markets with supply, causing localized price drops and destabilizing communities. Conversely, if investors continue accumulating properties, homeownership could remain out of reach for millions, cementing a long-term shift toward a predominantly rental-based system. Policy will be crucial. Governments can incentivize first-time buyers, subsidize affordable housing, or adjust property taxes to ease pressure. Without coordinated efforts, the market could remain skewed in favor of those who already own property or have access to significant capital. Affordability will continue to define the next decade, shaping who can buy, who must rent, and who leaves cities entirely in search of lower costs. Demographics will also shape outcomes. Millennials, still entering peak home buying years, will influence demand patterns in cities and suburbs alike. Generation Z is beginning to enter the market with different priorities. Flexibility, remote work, and lifestyle are often more important than traditional urban cores. Cities that adapt to these trends, by improving infrastructure, offering amenities, and managing housing supply, may attract new residents. Others could stagnate as residents move to more accommodating regions. Technology will play a role too. Online platforms, data-driven pricing tools, and AI-assisted real estate apps could change how homes are bought, sold, and rented. Investors and buyers will have more information, faster transactions, and the ability to make decisions instantly, potentially widening the gap between those with resources and those without. Ultimately, the hidden crisis is far from over. The system that once provided stability has fractured, and its trajectory remains uncertain. Prices may stabilize, rents may continue climbing, or new shocks could appear from economic, political, or social changes. What is certain is that the American housing market has entered a period unlike anything previous generations experienced. The ladder to homeownership has become steeper, the terrain more unpredictable, and the stakes higher for millions of families. The coming years will determine whether the market adjusts, adapts, or remains out of reach. And while the crisis is largely hidden in headlines and statistics, its effects are felt every day by families, renters, and first-time buyers who are left to navigate a system that has quietly, profoundly changed.